Friday, November 10th, 2017, Monaco 64, home of alternative economics and contrarian views. So it's almost 10 p.m. London. Markets are shut, except for cryptocurrencies, of course. And I want to talk about the gold price and what happened today after the LBMA fix. The LBMA PM fix is from 3 p.m. London or 10 a.m. New York. And why is it from? Because it might take a little extra time from 3 o'clock for the auction process to end. But if you look at the gold price today, we're trading above 1280, around 1284, 85 most of the day. And then after around 3:50 p.m. London or just before 11 o'clock New York, gold dumped massively. And why? What did they do it after the PM fix? Well, because the FX market in London shuts after that, especially the gold physical market. And so the futures on the CME have, carte blanche, so to speak. The manipulators, the bullion banks, can come and sell as much paper as possible. But prior to the PM fix, it's difficult because the physical market's still trading. And this is, just goes to show to the people that think Bitcoin will be immune to this kind of activity once the CME futures starts trading. I think they're deluded, because today is a great example of how the bullion banks and they come in and they basically sell billions of dollars of paper and drive the price of gold down like in minutes. Like from 1284, I think the low, it went down straight down to 1273, and gold was unable, to go back above 1280 and just closed the week at around 1275. Before I look at the price action, though, I like to go back to an article that I actually wrote in May of 2017. And it's entitled "The London Gold Pool Revisited," and it was published on marketoracle.co.uk. So I read from my own article. It says, back in the 1960s, when the dollar was still fixed to gold at a rate of $35 per troy ounce, the United States Treasury and the other financial policymakers of the time were having more and more difficulty in maintaining this fixed rate at $35 in the London and European foreign exchange markets. From 1933 to 1975, gold could not be traded in the United States, so there was no official market in New York. The major reason for this difficulty in keeping gold pegged at $35 per troy ounce was that the U.S. government was printing dollars with no corresponding increase in its gold reserves. And as a result, the participants in the market started exchanging these inflated dollars for the real thing. And I go on to say, this is how Bill Buckler of The Privateer described the situation. And I quote Bill Buckler. The Privateer used to be a really good website. He closed down a few years ago. And he quotes, by the beginning of the 1960s, the $35 per ounce gold ratio was becoming more and more difficult to sustain. Gold demand was rising and U.S. gold reserves were falling, both as a result of the ever-increasing trade deficits with the U.S., which the U.S. continued to run with the rest of the world. Shortly after President Kennedy was inaugurated in January 1961, and to combat the situation, newly appointed Undersecretary of the Treasury, Robert Russa, suggested that the U.S. and Europe should pool their gold resources to prevent the private market price of gold from exceeding the mandated rate of $35 per ounce. Acting on this suggestion, the central banks of the U.S., Britain, West Germany, France, Switzerland, Italy, Belgium, Netherlands, and Luxembourg set up the London Gold Pool in 1961. The pool became unstuck in 1968 as the participants had enough, as the wave of inflated dollars kept flooding the market as the U.S. kept printing dollars to pay for the Vietnam War and Lyndon Johnson's Great Society welfare program. The French, under Charles de Gaulle's leadership, broke the pool as they started redeeming their paper dollars for gold. And I go on to say this is in 2007. So 10 years ago, I already saw this, in the markets, watching the gold price every day. And I said, today we experience a similar situation as the United States is involved in another war, and this time in the Middle East, and at the same time is running huge trade and current account deficits with its trading partners in order to keep the American consumer happy. The dollar, of course, is not pegged to gold anymore, but the price of gold is still a signal pointing at U.S. government inflation and profligacy. With gold approaching $700 per troy ounce in the last couple of months, we have seen central banks selling. The other pattern that we have noticed is that the gold price seems to firm up during Far East trading hours and sell off in London AM session prior to the New York AM opening, or the Comex. What time is it? It opens at 8:30 AM New York. The London gold pool of the 1960s was an overt agreement, as the fixed price of gold was official policy. Nowadays, there is no official or pegged gold price, but it surely looks like a covert London gold pool is trying to keep the price of gold suppressed. Have a look at the chart below and notice how in the last 6 trading sessions, gold has fallen as we approached noon in London. It will be interesting to see the day when the 21st century London gold pool breaks. So that's what I said in 2007. So this is nothing new to me. My question is to the CFTC here, Commodities Futures Trading Commission. So what is the CFTC? Well, the CFTC is an independent agency of the U.S. government created in 1974 to regulate futures and options markets. So I asked the CFTC and Mr. Christopher Giancarlo, who's the chairman of the CFTC, appointed by President Trump on August 3rd to be the chairman. What are you going to do about it? Isn't the price action in gold, this afternoon or late morning in New York, isn't that suspicious to you, Mr. Giancarlo? If that had happened to, any other futures, a financial future, like the Treasury note future on the CME or anything else, I'm sure you'd be looking at this. Why do they manipulate the gold price? Well, as I said in my article from 10 years ago, a rising gold price is a barometer of the health of the fiat money system, or the US dollar, which is the main pillar of this fiat money system we've had since 1971, August 15th, when Richard Nixon closed the gold window. 10 years ago, I wrote that article when gold was being kept below 700. It was frustrating. You'd never have thought that gold would be, higher than 1,000 back then. Maybe this is the same thing that's happening now. So we just need to be patient. The CFTC probably will not look into this because, why would the U.S. government try to undermine its own operation of trying to keep the dollar, with a semblance of value? Because that's what gold would do. If gold went up too quickly, it would totally discredit the US dollar and the whole fiat money system. So if you enjoyed this video, please like, share it far and wide, subscribe to my channel if you haven't yet, and you can also follow me on Twitter and on steemit.com. And I'll talk to you later. Bye.